Welcome to Strategy Saturday. I'm Charles Carillo, and today we're breaking down 5 dangerous myths that are hurting multifamily investors. And understanding these myths will save you time, money, and frustration, no matter if you're just getting started or you already own some properties. So let's break it all down, starting with the biggest misconception of them all. So after listening to some real estate podcasts and YouTube episodes, you will be quickly inundated with all the benefits of multifamily investing and why you too should become an investor. Still, since investing in my first multifamily property, I've realized many misconceptions about what multifamily investing really consists of. And I've chosen these 5 myths that many investors and gurus still consider to be true. Number 1 is that it is passive. Now, it is not a passive investment if you're actively purchasing multifamily properties. Yes, the revenue is recurring and you can hire a property management company, but that will only make your investment semi-passive, removing you from the day-to-day, also known as asset management, which for me and other investors is fine. But if you think you're going to buy a property, hire a property management company, and then have no more interaction with the property, nothing could be further from the truth. If you build an extensive enough portfolio, you can hire an asset manager, but we asset manage all of our properties, and I suggest all of our investors do the same. When there is a call with our property manager, someone from our team or myself is on that call, and we will share the recording with all the other partners and team members. So everybody is in the loop immediately as something happens or that we have any type of updates. Number 2 is cash flow from day one. Now, I've never purchased a multifamily property and collected cash flow from day one, which I put into my pocket. As a multifamily value-added investor, there are stages that most properties go through, from what I call the initial stabilization stage through the renovation process to being a stabilized property. And this could take months or could take years, depending on the size of the property. Even the most renovated properties I've purchased still took months to finalize and get on track. Another reason you need a proper reserves when you're buying real estate. Number 3 is consistent cash flow. Now, the consistency of cash flow greatly depends on many factors, including the property class, the tenant base, the condition of the property, etc. A solid 20-unit B-class property in a B-class neighborhood will have more consistent cash flow than a 10-unit C-class property in a C-class neighborhood. Properties with more units have more income streams. Better quality areas and properties typically attract more financially sound tenants, also known as credit tenants, what we call them, making collections more consistent. However, when you own multifamily properties, you own a business with ups and downs. It's not an annuity, another reason for having a reserve fund. Number 4 is you can do it with no money. Now, if you're buying multifamily properties, not just wholesaling them, you need money. Not that it all has to be yours, but you need money even if you just purchase it with no money down. You still need to make repairs, upgrades while having and maintaining a reserve fund. Now, if you feel you can pay for those repairs and upgrades from cash flow, that is one of the biggest mistakes a multifamily investor could ever make. Check out episode SS167, that's SS167, called Zero Down Doesn't Mean $0, where I break this down in more detail. And 4B part of this is that if you find a deal, the money will come. Yes, if you've been investing in the asset class and market for decades with a solid track record and a list of investors who trust you, this is a myth for a new investor speaking to strangers about a deal. This is exactly why my first passive investors for my syndication deals were business partners from past business dealings outside real estate. They knew me and trusted me for years before seeing the deal and ultimately investing. Number 5 and last point is that it's impossible to find good deals. Now, I had this mentality for years until I realized that everything is difficult. Today's economy is highly competitive, especially in real estate, and many other people are trying to do the same thing you are doing. This is why the sooner you start focusing your property search on specific neighborhoods, property sizes, etc., the more successful you will be. When you say you only invest in 10 to 30 unit properties in these neighborhoods instead of just saying I invest in the whole city, it'll make you an expert in these areas, and brokers and your investors will take you more seriously. The second part is understanding that you most likely need to search through 50 to 100 plus properties to find one deal. Now, coming to terms with these 2 points made my real estate investing much more realistic, since now I truly understood the time it would take to find deals that actually worked out. This episode is not meant to discourage new multifamily investors, but to adjust their expectations of the realities of apartment investing. Becoming a successful multifamily investor takes years, but it can be extremely rewarding, as it is a great way to generate income and generate wealth. And if you want to learn more about common rookie multifamily investing mistakes, please check out episode SS181. SS181. I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. If you're interested in actively investing in real estate, please check out our courses and mentoring programs at syndicationsuperstars.com. That is syndicationsuperstars.com. Look forward to 2 more episodes next week. See you then.
If you always wanted to invest in real estate but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you, since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.